Hi, I'm Justin McNichols, and I head the investment team here at Osborne Partners. Obviously, it's been an unprecedented 25 days. Global markets have fallen 35 to 40%, depending on the region. And this is the fastest bear market on record. The depth of this bear market is actually worse than the 1987 crash. And although most of our investment team members have experienced many major down markets from 2018 to 2016 to 2011 to 2008 and 2000, no manager or analyst working in the industry has ever experienced a virus-induced bear market. This is a once in a generational period, and we felt it was appropriate to share how our team collectively thinks about this environment. In this video, I'll detail what we feel are the ingredients that are necessary to end this bear market. And then at the end, I'll talk about what characteristics we're using to derive ideas in this market, with many companies trading at deep recessionary levels. So as we move on to the ingredients that we want to see to end this bear market, as an investment team, we feel they fall under four categories. The first is the virus itself. The second is the market function. The third is the Federal Reserve and the government. And the fourth is more sentiment and technical checkpoints. So let's review these together. First, as far as the virus is concerned, what we've noticed is ever since the virus started with China and moved on to other countries such as South Korea, Japan, and Singapore, if countries are relatively diligent about sheltering, locking down, and really allowing the virus to flatten out, usually we see the virus starting to flatten as far as the number of new daily cases. It starts around, say, the 25th to 32nd or so day after the country has experienced their first 100 cases. So the reason we look at Iran, Italy, and Spain, for example, is because those are the three countries that are relatively major that had their 100th case right before the United States. So as we see these countries flattening, our feeling is that the United States should be relatively close behind. So we first want to look at Iran. Iran has already started to flatten, which is good news. In the next few days, we should see Italy start to flatten, then Spain start to flatten, and that will give us the opportunity, hopefully if we are diligent, that we can follow the pattern of these 8 or 10 major countries before us and watch the virus, the number of cases flatten out in the United States as well. Extremely important as well as a team, we want to make sure we don't see any coronavirus reversals for countries that have flattened. Then maybe they stop sheltering, stop the lockdowns too quickly, and the virus starts to grow again. So we want to make sure we don't see any countries reverse. So that's what we want to see from a virus standpoint. From a market function standpoint, which is really important to your portfolio, we want to make sure that the US Treasury market volatility that's been very high lately, we want to watch that slow over time and that volatility fall. As you can see there on the right side, we do not have a check mark next to that item because we have not seen that volatility fall yet, but we're expecting it to happen relatively soon. Additionally, we saw credit spreads blow out, and what I mean by that is the difference in yield between high yield bonds and treasuries, which earlier in the year and late last year was hanging out around the 3.5% to 4.5% area. It's now moved toward 11%, meaning high yield bonds have yields that are 11% higher than treasuries. We want to see that spread narrow. That'll show markets are more calm. And at this point, we have not seen that yet, but it is relatively early. Then we're talking about the Federal Reserve and the government. And these are areas that will help the economy push through this very quick, very severe recession. And luckily, the two important items from the Fed and the two important items from the U.S. government, those have already occurred. We had talked very early in the virus outbreak that we wanted to see the Fed really inject liquidity into the system quickly, which they did. We wanted to see them lower the Fed funds rate, which they did. And we wanted the government to pass some kind of small business relief and the ability to temporarily help the most vulnerable portion of the workforce, which in most cases revolves around the service industry. What's great for our long-term ability to resuscitate out of this recession is that all four of those we've seen occur already. Then we move down to the sentiment and technical items. And really, these are what we need to see that give us a clear view that markets not only have settled down from a volatility standpoint, but that there's enough bearishness and enough cash on the sidelines that when fundamentals get better, there'll be plenty of cash that can go back into the capital markets. So there are five in particular that we're looking at. Three of those have already occurred. The first is the sentiment of institutional investors, which is taken every week. The number of bulls, we want to see the percentage under 30, and the number of bears out there over 40. We have seen that happen just in the last week. So that's a good sign that there are now a lot of people that are bearish out there, a lot of professionals that are bearish, meaning they have probably moved to the sidelines already. The second item is a spike in the amount of money markets fund data. And that fund data has spiked over the last couple of weeks as well. So there is a lot of money that has panicked out of capital markets and into just money markets. We think that's a very good sign. Then something we may be able to check off tomorrow, which is the first day that we're going to see very high weekly jobless claims, since so many people are out of work just immediately. So if we can see a very high jobless claims number, which we absolutely will see, estimates out there are in the 2 million area. We feel it's even going to be higher. If we can see markets only down slightly or flat or even up on very bad news like this, this is quite a positive in getting markets moving again and having investors look to the future. And then finally, two items that have to do with the volatility index, which the ticker symbol is VIX. The volatility index presently is very high. We'd like to see that fall over time, especially on down days, and that'll show that a lot of the volatility is coming out of the markets. And we also want to see the futures curve, which basically predicts what volatility will be like in the future. We want to see that come down as well over time. And we've actually started to see that fall for the April futures curve. So that's relatively good news. So overall, when you look at all these ingredients, the virus, we'll have to see those occur over the next week, hopefully. Market function, we want to see those spreads in the treasury market start to act a little bit more normal. The Fed and the government have done a lot of the heavy lifting here already. And then from a sentiment and technical standpoint, we're going to see what happens tomorrow. And we're going to see if the volatility index can fall over time as well to a more normal level. So in conclusion, as I mentioned earlier, I was going to review really what characteristics we're looking for in this environment to derive new ideas in the market that's presented to us now. And as I mentioned, we have a number of ideas that are trading at deep recessionary levels. But how do you figure out whether fundamentally these are going to be good ideas for the portfolio over time? Well, we're taking really kind of a four-step methodical process as a team here. First, we're looking at a company's business and their overall revenue. And what we're trying to isolate are companies that have very little effect as far as the virus is concerned, as in it does not affect their business directly. Also, companies that are in businesses that are very essential, but their revenue is temporarily affected by the virus. And then third, companies that, again, have their revenue temporarily affected, but these are businesses that going into the virus had a lot of tailwinds and business was really looking good. And our feeling is that the virus will not derail the fundamental tailwinds that were behind these companies. So we're looking at a number of companies that have those characteristics. Then we take it a step further and look at their balance sheets. We want generally low net debt to EBITDA. And basically that equation is you take a company's debt, you subtract their cash, and you divide it by what we feel the EBITDA will be going forward. And you want a very low level. A lot of people look at, say, 3 or less being a good ratio. A lot of the companies we're looking at right now have net debt to EBITDA of basically 1 or less. Additionally, we want to make sure these companies don't have a lot of debt coming due in the next year or two. This is to be extra safe. And then we take the companies that have kind of passed those revenue and balance sheet screens, and we move on to a very important stress test. And what we're doing is we're taking these businesses and we're stress testing them for a deep recession. Whether we're taking 2008 or 2011 or 2000, we stress test their income statements to see what their business looks like deep in a recession. We take that income statement and then we go to valuation. And on a valuation basis, we're looking to buy companies not only that have those revenue characteristics, those balance sheet characteristics, those stress test characteristics, but are trading at valuations that we normally see in deep recessions. So you put all those together, and what we're usually buying are companies that have, very high upside with downside that tends to be in the 10 to 15% area. So kind of these 4-to-1, 5-to-1 type upside to downside situations, which with any kind of reasonable time horizon should really pay off for us over time, since normally we're not able to buy companies of this high quality. So in conclusion, I just want to tell you that the uncertainty right now makes this bear market particularly stressful and emotional and worrisome. However, if we continue to use our methodical discipline to find these higher risk, higher reward, lower risk holdings, and constantly improve the portfolio that we manage for you on a multi-asset class basis, our work will definitely pay off over the next 6 to 24 months. And it's our opinion that possibly a lot of the purchases that we're making now and a lot of the ways that we're improving the portfolio in all asset classes now will possibly help your portfolio more than a lot of the purchases we were making at the depths of the global financial crisis in 2009. So we appreciate you being patient and loyal with us and confident that our team is really methodically managing portfolios through this environment. And just please know that we're taking a very disciplined approach to improving your portfolio every day. So we look forward to talking to you soon, and thanks for listening to us today.